are in listen-only mode.
We're ready to go.
Hello and welcome to the first webinar, the final webinar, in the series of Growing Farm Profits webinars hosted by Southern Sustainable Agriculture Working Group, specifically for agricultural professionals who assist diversified vegetable growers. This webinar is made possible with the generous support from the Southern SARE program. Hi, my name is Steve Muntz. I am the Executive Director of Southern SOG, and I want to welcome you all to the webinar today. Assisting me today is Julia Sampson. We'll be in the background trying to keep things running smoothly, and we hope you enjoy the webinar today and are glad that you've joined. Thanks very much. So today's webinar is titled, Preparing Farmers to Meet with Lenders. Many farmers need a loan for purchasing and or operating their farms. If farmers don't know what information they need to gather prior to actually meeting with the lenders, chances are they're going to be nervous, frustrated, and overwhelmed. A little planning and preparation can make all the difference in both the amount of time and the process that the process takes and whether their loan's approved. So in this webinar, you're going to learn how to guide a farmer in preparing to meet with a lender to request a loan. Before we begin, I'd like to give you a little background about Southern SOG. The organization began in 1991 in Newmarket, Tennessee, with a group of farmers and farm advocates seeking to raise the voice of Southern agriculture to the national level. Since those early days, Southern SOG has a rich history of partnering with hundreds of organizations and thousands of individuals in 13 states across the South. The mission of Southern SOG is to empower and inspire farmers, individuals, and communities to create an agricultural system that is ecologically sound, economically viable, socially just, and humane. Because sustainable solutions depend on the involvement of the entire community, Southern SOG is committed to including all persons of the South without bias. We work in three primary program areas: sustainable and successful family farms, community food systems, and bringing the Southern voice to the farm policy dialogue. Southern SOG is probably best known for our annual conference. This coming January, we'll host our 26th conference in Lexington, Kentucky. All of our conferences are renowned for the outstanding practical information provided and the networking opportunities. We also have an extensive trade show, 6 free conference field trips, 5 short courses, and 2 mini courses. The full conference program should be online. Actually, it is online now. We're very pleased that this year the Organic Agriculture Research Symposium is going to be held in conjunction with the conference. This symposium is being hosted by the Organic Farming Research Foundation in conjunction with the University of Kentucky and Kentucky State University, and will feature researchers from all disciplines related to organic farming and food systems. Participants will come away with the most current information on organic agriculture. Check out our website for more information on this symposium that will be in conjunction with our conference. Now a word about the Growing Farm Profits program. Southern SOG and our partners developed the Growing Farm Profits program in 2011 in an effort to help farmers get to the heart of profitability on their diversified vegetable farms. To date, over 400 farmers, future farmers, and farm service providers have participated in the trainings. Feedback from across the spectrum of participants over time has indeed shown a positive impact on farm profitability. In 2015, Southern SOG offered our first series of single-topic Growing Farm Profits webinars for farm service providers that allowed further exploration of some recurring issues farmers face in profitability management. You can find recordings of these webinars on our website, ssawg.org. This year we've expanded the webinar series by addressing 2 new topics. Today's final topic focuses on preparing farmers to meet with lenders. It's our hope that some of you Texans out there who participate in these webinars will want to dive in a little deeper and join us for one of the Growing Farm Profits in-service trainings that will be held in Texas in November with our partners, the National Center for Appropriate Technology and the University of Texas Rio Grande Valley. Our presenter for today's webinar is Gary Madison. Gary works for the Farm Credit Systems Trade Association in Washington, D.C. as Vice President of Young, Beginning, Small Farmer Programs and Outreach. This includes policy work on local foods, sustainable agriculture, and direct-to-consumer agriculture. Until recently, Gary was a small farmer raising greenhouse wholesale cut flowers, marketed in the Northeast, and beef cattle for local sales. He served on numerous boards of directors, including Farm Credit, the Boston Flower Exchange, and many nonprofits. Now I'm going to pass the program over to Julia Sampson.
Hello, my name is Julia Sampson and I work for Southern SOG. Before we get started, I'd like to provide you with just a few points on some of the webinar logistics. We've got many participants in the webinar today, therefore all lines have been muted. Now, the webinar is being recorded. We're going to share a link to the recording soon after the webinar via email, just in case you want to watch it again or share it with some of your colleagues. Each of you should be able to see a control panel. Let's see here. And let's see. Okay, so the control panel looks like this on your screen. You should be able to see, expand and contract the control panel with this orange grab tab here. You're free to ask and submit questions via the question box right here, located on your screen as shown in this slide. We're going to be addressing your questions at the end of the presentation. But before we get to that, we'd like to know a little bit more about who you are, who's in the audience today, and your current level of understanding of our topic. So in order to do that, we have a quick pre-webinar survey that will consist of just 3 questions, 3 quickie questions. Each question will pop right up on your screen as I launch the poll. And I'll give you about 15 seconds to respond to each question, and then I'll show the results to the whole group. So let's get ready for question number 1 here. Okay, so question number 1. Do you currently or will you in the future assist diversified vegetable growers with their farming operations? So it's a simple yes or no question, and I can see that everyone has voted. Well, I'll give you about 5 more seconds to give a few more people a chance to vote here. But we want to make this like right off the top of your head, just a really quick answer. Are you dealing with farmers right now? So I'll go ahead and close this poll and go on to the next one. And then I'll share the results with you right there. So as you can see, most people are working with diversified vegetable growers. I'll go ahead to question 2 here. What's your confidence level? So we're going to hide that. And then we're going to go to number 2. So very quickly here, what's your confidence level in assisting diversified vegetable growers with preparation to meet with an ag lender? So your confidence level is none, low, moderate, high, and we'd like to just get a real quick answer to this and get most people to weigh in on this. This is your chance to vote and pull the tab here for a vote. It helps us with our future programming, and it helps us know how we're doing. So I can see that most people have voted here. I'm going to go ahead and close the poll and share the answers with you there. So we've got low to moderate. Most people are there right there in the middle there. So we're going to go on to the 3rd and final question here. And I appreciate people being able to help answer these questions for us. So the 3rd question is, what's your confidence level in identifying useful tools to help vegetable farmers in preparing to meet with an ag lender? No confidence, low, moderate, high. This is a quickie poll, and I can see the answers coming in here. We appreciate your participation. I'm going to go ahead and close the poll and then show you the answers on the screen there. So we have 3/4 of people are in that low to moderate range there. I'm going to go ahead and finish with that. Thank you so much for your participation in this short survey. Now I'll go ahead and pass the presentation to Gary Madison. Okay, Gary, I can see your screen, but I can't hear your voice right now.
Oh, I'm sorry. That was technical difficulty on my end. Thank you for telling me, Julia. If you're a beginning farmer yourself, I hope you can get a lot out of this presentation. However, this presentation is aimed at those who advise and train beginning farmers, and you'll hear me refer to those people as advisors. For those of you who are listening to this as live or as a recording, please make sure to look at your screens because I'm not going to read out loud everything that appears in the slides. I figure that you'll look at the slide and read for yourself, and I'll talk about what you are reading. Okay, let's go. By preparation, I mean all the things to talk about with a beginning farmer well in advance of meeting with a lender, laying the groundwork for both the beginning farmer and the lender to make informed decisions. Now, I want to emphasize that the goal here that I'm trying to accomplish is not to get a loan. The goal is to explain how the borrowed money will be used to make a profit, to make enough money to pay back principal and interest. It's one of those basic things in helping a beginning farmer understand that it's not a badge of honor or something to get a loan from an agricultural lender. The purpose of getting a loan is to make money with that money. Take an amount of money and turn it into more money through an agricultural business. As the advisor, I think it's up to the advisor to explain what the essence of a loan is, which boils down to renting money. It's analogous to renting a rototiller. To do a job where you've decided you need a rototiller to prepare the growing area, you get the rototiller and do the job. You pay money for the use of the rototiller, and then you return the rototiller. And in my analogy here, paying money for renting the rototiller is like paying interest, and returning the rototiller is returning the principal, returning money that you borrow. Of course, you have to pay. That kind of loan works may sound obvious, but the borrower's expectations need to be set for both what happens if things go right and what happens if things go wrong. What are the consequences? And as an advisor to beginning farmers, you have a moral obligation to assess that beginning farmer's capacity to understand both the plan for making money with the loan as well as the consequences if the loan cannot be repaid. Your job is to ask the right questions. Now, what I've just described is really the principle of constructive credit, which means that the borrower is not going to be made worse off by getting a loan. It's easy to see that too big a loan can be a bad thing for a farmer, where that farm business idea is just way beyond the capabilities of the farmer to accomplish the project. Part of preparing a beginning farmer to get a loan is making sure they understand what the lender wants out of the deal. And let's be clear, what's happening when a loan is being sought is a negotiation. If you cannot walk away from a negotiation by saying no, then it's not a negotiation, it's pleading. If both the beginning farmer and the lender understand how the proposed farm enterprise makes money sufficient to pay the farmer and pay back the loan, then there's a meeting of the minds that makes for a balanced conversation between parties that are interested in doing business with each other, and that creates room for negotiation. Okay, so all of this is what I would consider deep background that should be communicated to a beginning farmer over the course of a conversation, not necessarily all in one dose, and probably not where I would start the conversation, but these ideas, what constructive credit is, what a loan is, what the goal is as far as taking that loan out and using it to make more money, are essential concepts to be communicated. I also think you need to make sure that your beginning farmers that you're training understand that they have to earn trust. I call this a humility lesson. If your beginning farmer is not able to at least fake humility, things may go badly when talking to a lender. Nobody likes dealing with somebody who feels entitled. Perhaps a way to communicate to a beginning farmer the idea of the borrower-lender relationship is to express it in terms of how to be a valuable partner. What does that lender want to see in a potential borrower? They want to see a business plan and accurate financials, but they also want to be able to tell that that beginning farmer, potential borrower, is seeking an honest and ethical relationship, and basically intends to pay the loan back. Well, maybe it's easier to describe from the other direction, how a lender can be a valuable partner. But either way, The beginning farmer needs to have you, as an advisor, help them set expectations for both their behavior and what to expect from the lender. By planning, I mean the things that you as an advisor have to teach about business planning, what roles you have to play over time in order to get the beginning farmer to see the importance of planning and to be able to talk in an organized way about their plan. I'd first talk to a beginning farmer about what they're interested in. What's the plan for their farm business that they envision, and how they can best describe it to a lender in a way that the lender can understand how the beginning farmer will make money and repay the loan. And that means speaking in numbers and calculating consequences and contingencies in words. This is not normal behavior for a beginning farmer, but fortunately there are financial tools that you can teach them to describe and use, and we'll cover those in another couple of slides. So as an advisor, you have a role as a translator. You have a role as a coach. You've probably played on a sports team of some kind. Your coach is the person who tells you what you're good at and also what you're not so good at. This is the role where you as an advisor tell your beginning farmers to put on their big boy pants and own up to a self-assessment of their business skills. These three basic business skills of financial, production, and marketing must be present in any small business, a farm business or not. Every business needs these three basic skill sets. I've never met anybody that has all three in equal measure. It's important to be able to look at this list and say, gosh, I know what I'm best at as a beginning farmer. Way back in the previous century when I was a beginning farmer, I felt I was good at production. I like to do things. I like to work with my hands. Most beginning farmers get into farming because they want to be a producer. They want to be with the cattle. They want to work on the tractors or the hydraulics. It's all about producing something and that kind of success. Certainly some are interested in marketing. Somebody who runs a CSA or a farm stand certainly better have an interest in marketing. There's not a whole lot of farmers that go into farming because they want to be an accountant, because they're interested in the financial side of it. But even so, it's an essential business skill that can be rented in the form of hiring a bookkeeper or even a CPA if things get very complicated. But that skill set of financial skills needs to be impressed upon a beginning farmer, that somehow they need to have somebody there that's keeping records about their financial performance. Ideally, it's going to be the beginning farmer, so they have the greatest understanding of their operation. But it's a fairly easy thing to hire a bookkeeper to prepare financial records. I also think as an advisor to beginning farmers, there's a role as kind of the Zen Master. This is a step beyond coaching someone what to do in the field. The Zen Master aspect speaks to the need for an integrated view of all levels of crop, farm, income, and life. This is the role where you challenge the confidence of the beginning farmer by pointing out the holes in their plan. And by doing this, you're teaching them dispassionate analysis, how to see their plan from someone else's perspective. You're telling them they have to understand the big picture of the wager they're about to make on their future, that, as the chart shows, the ultimate goal is to have a household that is financially stable, whether that's entirely from farm income or it includes off-farm income. And just as a personal thing here, please do not torture your beginning farmers by holding out the goal of they should earn all their living from farming. They should be a full-time farmer. I think that's a poor risk management strategy. It's putting all your eggs in one basket. It's certainly a problem for a beginning farmer that should much more realistically have a business plan that shows how they're going to farm part-time and on weekends, and then grow themselves into a business once they have the experience to having managed a business that's at a smaller scale over time. And also, if you think about a beginning farmer turning into an experienced farmer, is that farm business capable of supplying for the changing needs of life? You know, I had kids that grew up while I was operating the farm business, and instead of choosing to expand the farm business, I went into other businesses that were opportunities available to me as a rural entrepreneur. If you think of yourself as an advisor, teaching someone the life skill of how to be in business, no matter what that business may be, being successful at business planning and management and interpreting financial results, you're really giving them a life skill so that they're not just going to be possibly a farmer, they are going to be a rural entrepreneur and start multiple businesses. And of course, part of your role as an advisor is as mom. You know, the best advice moms give is eat your vegetables, they're good for you. Well, okay, all right. Moms give lots of advice that is more relevant, but the generic mom advice is to do the things you know are good for you, take responsibility for yourself, and assure a complete and to do that, you're going to assure a complete and satisfied life if you do that. It just happens to be delivered with lines like eat your vegetables, do what's good for you. But your role as an advisor, as a mom, is to help set goals. And those of you who are looking at this slide and experienced in advising beginning farmers know that the list of things to do on this slide, setting measurable goals and evaluation standards, demonstrating management capacity, planning capacity, those are the hardest things to get students, beginning farmer students, to accomplish. And that's why your greatest skill set in training comes from playing the role of mom. I just want to point out that last bullet of keeping good records as a way to establish eligibility for whole farm revenue crop insurance is another good reason to beat beginning farmers over the head with the idea that you got to have good financial records. If you don't have good financial records, if you don't have any records, good or not, you can't get whole farm revenue insurance. You must have records in order to demonstrate that you've been in business and you have a certain degree of earnings from your farm business. Okay, well, understanding the difference between what lenders and farmers, and I'm talking about well-trained farmers here, what those two groups, lenders and farmers, think about financial tools is worth mentioning. I think the financial tool most important to a farmer is the monthly cash flow budget. And as a farmer is trying to explain how business works to somebody else, the monthly cash flow budget is the one spreadsheet I would want to have on hand to be able to read from and be able to say, here's the month that I earn my most money. Here's the month where I have the highest expenses. Here's where I might have to borrow some money to meet those operating expenses. All of those things come off of a monthly cash flow budget. The other things that are important to a farmer, capital expenses budget, which you know, that's a fancy way of saying my wish list for the equipment that I want to buy. You know, I want to buy a new tractor, I want to buy a walk-in cooler, I want to buy a plastic layer, whatever that is, that's a capital expense budget. And then income statement and balance sheet are put in what I consider descending order of importance to a farmer. If you look at the other side, the other column, to the lender, the most important financial tool is the balance sheet. The lender wants to cut to the chase, answering that question, can I lend this beginning farmer money or not? And the balance sheet tells her how much equity the beginning farmer has, which will determine how much the beginning farmer can borrow. And you'll note that the list of what is important to the farmer is the inverse of what's important to the lender. Now, this is certainly a broad generalization, but your job as an advisor is to prepare your beginning farmers to understand what each of these financial tools or reports means to them, and also how the lender looks at that exact same financial report. Helping a beginning farmer understand how someone else looks at that report and is really part of that is saying how important it is to the lender. Since the balance sheet is the most important financial tool that the lender wants to see, having a history of balance sheets, you know, over several years is certainly a step up in the kind of information disclosure that really warms the heart of a lender, to know that that potential borrower has a sense of how they have earned money over time. If you're not recommending to your beginning farmer trainees already, recommend to them that pick a date, December 31st, January 1st, do a balance sheet, a personal balance sheet. What are you worth? Cash on hand, debts, the typical assets and liabilities that are on a balance sheet, to be able to demonstrate that you have paid attention to your financial situation over time, that you are indeed, as that beginning farmer, you're paying attention to your wealth, to wealth generation. And also, one last thing on importance to the lender, I put in family living expense, which isn't exactly a financial tool. It's kind of a number that I would guess that most beginning farmers, most people walking around, don't have a sense of how much they spend just to live. You know, their cell phone budget, putting gas in the car, insurance, food, you name it. It's a good idea to help a beginning farmer understand what they spend just to live on, because that's going to be a question that the lender asks, because that's part of the equation of determining how much capacity a potential borrower has to pay money back. Are they living high on the hog? Do they, does it take them $50,000 a year in personal expenses to run their life, or do they do it on $25,000? So helping the beginning farmer understand what their personal expenses are is an important part of preparing for meeting with a lender. Okay, the presentation, the big day, the final exam, the walk up the 13 steps to the well, no, I'm just kidding about that last one. But we have to recognize that that's how the beginning farmer is going to be thinking about the visit to the lender. It's extremely nerve-wracking. The beginning farmer may see this as a do-or-die performance in front of a stranger that holds the key to their future. And my best advice regarding that first visit to see a lender is that it should happen a month or two before the beginning farmer is actually sitting down to ask for a loan. Farm lending is a relationship business that needs to start casually before going in to make the ask. For the beginning farmer, going to a lender's office is scary and confusing. That the reason for going there for that's the reason for going there for a get-to-know-you sort of visit before seeking a loan. The topic of the get-to-know-you visit can be that list of qualities back on slide 8 about how you can tell a lender will be a valuable partner. So, things like knowledge of agriculture or the capacity of the lender, clear communications, other characteristics. Another question at this get-to-know-you sort of meeting is, what information do you need from me when I'm going to apply for a loan? Every lender is going to have a little bit different formula. It's probably going to include things like, I need to see a balance sheet, or a couple of years of balance sheets would be better, 2 or 3. The lender may ask to see the last 3 years of tax returns, particularly if a Schedule F farm income is reported. If that person has been a manager of another business, having a job description to demonstrate the experience may be asked for. There's all of those things that get asked for kind of sort of depend on the scope of what's being asked for in the loan, as well as how complicated that business is. In general, the more that the lender understands the business and has seen it before, probably the less information they're going to need, because they're already familiar with the nature of the business. If you are proposing, as a beginning farmer, a more complicated business or a business that the lender isn't familiar with, then you're going to have to show more information. Okay, so the meeting itself, sweaty palms, racing heart, nervous laughs. Okay, that's likely how the beginning farmer is going to feel, but it can sometimes describe the loan officer. Think about it for a minute. If this is the first time that loan officer is going to talk to somebody who wants to be a CSA vegetable farmer instead of a corn and soybean farmer, then that loan officer may indeed be very nervous because they don't understand that business. And they're supposed to be the lending expert, right? So that's another reason for that get-to-know-you meeting, that going into the lender and saying, you know, I'm thinking about being a CSA vegetable farmer. Here's how the business works. You're giving them a little bit of background and giving them time to do some research and just to think about it. How would that business work? You'll answer those questions when you give them a business plan or a monthly cash flow budget when you actually go to ask for the money, but letting them know ahead of time the kind of space that you're going to be in is certainly very productive. So the actual meeting to ask for the loan after you've established this relationship, certainly attitude is important, positive attitude, and the pitch should be, by that I mean, you know, there should be a summary. I always describe this as the 45-second elevator speech. For instance, I want to be a CSA farmer. I'm going to do it on 10 acres of land for which I'm seeking financing for. I expect to gross about $150,000 in sales in the first year with a net profit margin of 10%, meaning I'll have a net profit of about $15,000. My overhead is going to be fairly low, and I'll be my partner has an off-farm job, and that will provide us with some economic resiliency in case things don't work out like I expect. Now, I just made all that up, but that's about a 45-second description of a business. If you can say that up front in this meeting with a loan officer, that sort of clears the ground. You know where that lender knows where you're coming from, knows that you've calculated something which seems simple, but as complex as what my net profit is, what I expect. Being able to show expectations as a beginning farmer of profitability is extremely important because, as we'll see in another couple slides, that lender is really interested in not losing money, is really interested in profit being available to both pay the beginning farmer and pay back the loan. The actual ask should be very clear for as far as how many dollars you're looking for, over what period of time, because that's going to fit into your budget. There's another reason for a get-to-know-you meeting. You'll find out, you know, with a rough idea of what the interest rate being charged is, how long they're willing to write a mortgage on a farm business. So there's definitely a correlation here between that get-to-know-you visit and what you're going to be presenting at the actual meeting where you're asking for the loan. The supporting information that the beginning farmer is going to provide will hopefully include a business plan of some size and scope. The smaller the business, the shorter the business plan can be. But again, if the business is unfamiliar to the loan officer, it's going to have some detail in it to explain what the premise of the business is, how it earns money will be, or even if it's just a loan for a few $1,000s or tens of thousands of dollars. There's probably going to be some additional information that the lender is going to want as a result of the meeting. Rather than thinking, oh my gosh, I'm unprepared as the beginning farmer, thinking that I'm unprepared, I didn't bring everything. I think you should help prepare that beginning farmer to think of a request for additional information as almost an endorsement. Gosh, I'm interested in how this works. Can you tell me more about it? I guess maybe it's my optimistic attitude, but trying to take questions for more information and turning it into an opportunity for that beginning farmer to better describe how this business is going to work. It's entirely appropriate at this meeting, requesting a loan, to ask what the timeline is. How long do I have to wait for a decision? Who's going to be making that decision? Are you the person I'm going to call? How does this work? Loans are made in different ways by different lenders. That leads right to the next steps and follow-up, having expectations on both parties' parts about how long this will take. Don't be surprised if a loan officer can't tell you exactly. You know, they might say, well, it usually takes this or it usually takes that long. Part of the reason for any kind of waffling about that is, well, some of that comes back on the beginning farmer. Having, as advisors, helping your beginning farmers to understand that they really need to pay attention to their phone calls, their email, however they're communicating, so that they can get right on top of any request from the lender. They can respond as quickly as possible. If they get an email that says, well, I asked you for last year's tax return, I need 3 years of tax returns, the appropriate thing to do is send an email saying, I got your request, I'm working on it, so that the communication with the lender is always timely. Part of this is telling the lender that you're going to be responsive when they ask questions. The last thing a lender wants to do is lend money to somebody who's not going to answer their phone calls. Think about that in terms of, gosh, I'm not making loan payments. The beginning farmer isn't making loan payments, and the loan officer knows that this person is not going to return phone calls. It's not a good situation. There has to be setting an expectation of good communications. All right, let's move on. What the lender is thinking about, well, I think the first gate with most lenders is a discussion of the assumptions that are made in the business plan and how things are going to go wrong. It's not that lenders are pessimists that look at the world and just are waiting for the next problem to happen, but helping somebody else helping the borrower recognize that the best laid plans are still going to have something go wrong, because we're talking about agriculture. There's weather, there's hurricanes, floods, droughts, you name it. That's what agriculture is made of. Agricultural lenders, particularly farm credit lenders, understand that every year is not the best crop, that there are going to be bad years in whatever particular crop it is that you're growing. And the lender having confidence that the borrower is going to respond to those problems and has thought through many of those problems is what the beginning farmer needs to communicate. So part of your job as an advisor is to train the beginning farmer to talk about how things may go badly, but do it with a positive attitude. Being able to talk about disasters in a level-headed way demonstrates character, as well as the ability to plan and foresee things and prepare for something to go wrong. You know, in my business, in the greenhouse business, I depended on electricity for running furnaces in the winter and for running cooling fans in the summer. An essential part of my business planning was a generator to make electricity in case the power went out. It's that kind of discussion of, okay, my business depends on electricity, therefore I will do these things. Eventually I ended up with 3 generators because I had a backup plan and a backup plan for the backup plan and a backup plan for that. That kind of thinking through of consequences is the kind of thing that you want to coach your beginning farmers to demonstrate, either in writing in their business plan, as well as being able to have that attitude that when somebody asks them a question about something going wrong, they're not defensive about it, but they look at it as an opportunity to say, you know, I've thought about this problem, and here's what I intend to do about it. Now, with respect to the overall profitability of the farm enterprise, if the beginning farmer has only planned to be marginally profitable, then there's no room for error, no resilience to the plan. Similarly, not enough equity means that the beginning farmer has no resilience and no capacity to withstand a less than planned for crop. So from the lender side of thinking, low equity or no profitability in the plan are probably the most common reasons to decline a loan. Margin or profit margin is something that the farmer has control over. So bringing in a plan that doesn't show profit is something that you as an advisor can help avoid. Not enough equity is harder to solve. If equity might be an issue, look for another investor that, conditional on loan approval, will join in the venture. The bank of mom and dad, that they would put money into a beginning farmer if someone else will approve a loan is not an uncommon situation. Having such an investor means the farmer has sold the business plan idea to at least one other person, which can give some confidence to the lender. Looking at the income sources that are described by the beginning farmer, here's what I'm going to earn from my farm business, here's what I'm going to earn in my part-time job, or what my spouse or partner might bring into the household finances. Those are anticipated income sources would be, here's what my business plan says I'll be able to sell in CSA vegetables, and assured is more along the lines of, I've got a job in town. The lender wants to know what happens if the farm business fails. Is there still some capacity to both pay family living expenses and pay the loan back? Lenders do think in terms of probability of loss. Collateral can stand behind such a loss and secure the lender in the event of such a loss, but there's no lender out there that wants to have collateral pledged and then collect it. Collecting collateral, or when there's a default on the loan and the basically the farm goes back to the lender does not make money in that situation. It costs money to take back a farm, legal work, to sell that farm, market the farm, and then of course any proceeds in excess of the actual loan amount are going to go back to the borrower. The idea of the lender thinking, so if something does go wrong, does the beginning farmer have a plan for that? Crop insurance is an obvious solution to that. My example earlier of having more than one generator is certainly a way to describe a depth of risk mitigation. Who can you borrow a tractor from? That kind of thing. If a tractor is essential to the farm business for running an irrigation pump, let's say, what happens if the tractor breaks down? And the solution may be as easy in a risk mitigation plan as saying, well, my neighbor said I could borrow his tractor for a few days if mine breaks down while I need it for irrigation. Those sorts of things are what a lender wants to hear. What are you going to do about it? Of course, having a cosigner or another investor, like I had described, the bank of mom and dad, or a loan guarantee through FSA is certainly beneficial. It doesn't improve the credit quality of that loan, but it provides some security to the lender. And of course, there are the 5 C's of credit. I'll just list them here. There's something that as an advisor you need to know about and discuss. I'm not going to talk about here in this webinar because there's so many resources available on the topic. But just to be able to say to your beginning farmer trainees that this is how loan officers are trained. They want to look at character, capital at risk, capacity to repay, collateral, and conditions to mitigate risk. This is a good exercise to give to beginning farmers as they think about evaluating their own business plan. Have they addressed these topics in their business plan and the supporting financial documents? Okay, so sometimes the first no that you get from a loan officer is how a loan officer tells you what you need to do. They say, no, I'm not going to lend you this money, but here's what you need to do in order for me to make you this loan. And really, coaching the beginning farmer to think of this as the loan officer looking out for you. To have that loan officer say, I can't make you this loan the way it is, but if you change these things, I can make the loan, is really helping that beginning farmer think in terms of the risk that they're facing. The problem is, this sounds like a shakedown. The beginning farmer is told, in order to make this loan, we need these things done. And mostly those things are going to be conditions or more collateral or, an equity investor. But it sounds like they're being frisked. They're being shaken down for, I can't make you this loan unless you do these things that I want you to do. Well, if the lender isn't being clear about what exactly they need to be able to make the loan, then there's probably little chance that the beginning farmer is going to come up with the right solution. This is part of that negotiation idea that it's not pleading. If both parties are on equal footing, then the lender is saying, I can't make you the loan unless this happens. If, for instance, a condition may be, I'm going to lend you money. You came to me, Mr. Beginning Farmer, you wanted to borrow a tractor. I will make you the loan for the tractor if, as a condition of the loan, you buy insurance for fire and damage to that tractor. That would, after they've heard to borrow the money. If at the beginning farmer look at any kind of condition applied under, then it can lead the borrower rather to get a little upset. If the lender says something like, well, you need another $50,000 in equity to borrow this much money, that beginning farmer may not like it. They may not like that answer, but at least they have a goal. And they've been told, I'll make you the loan if you do this, if you come up with more equity. So there's a clear goal that's set by that kind of process. Well, the lender needs to be okay with their own process of coming to a decision. In this diagram, the kind of things that the loan officer is thinking about are compliance issues, risk and capital management addresses, how many farmers of a particular type, what's their portfolio concentration, things like that. Their management information systems, how are they going to enter all this information in? How will it be accounted for? Those are the kind of things that the loan officers, that's their world, that they have to fit this loan request into. And that the process of doing that, of approving a loan, is often treated like a proprietary trade secret, and that can be a little off-putting. The loan officer is not going to he's not going to give you notes to the meeting where the loan is being discussed. To some degree, the process of loan approval is indeed a proprietary trade secret business practice. But in the end, the goal is a single version of the truth that's commonly understood between the borrower and the lender so that everybody knows what they're expecting. After the visit to the loan officer and the beginning farmer has made their request, waiting for the news is the hard part. There are likely to be requests for additional information, but as I had said before, that's an opportunity to tell a positive story again about the business. It shouldn't be looked at as, oh my gosh, the loan officer won't leave me alone. They want more and more information. Well, if they didn't want to make the loan, they wouldn't ask for more information, I guess is the easiest way to put it to a beginning farmer. You don't know what kind of process there might be inside that lender, an internal credit committee, that the loan officer goes and acts as an advocate for the beginning farmer, saying, I think we should make this loan because of these reasons. There may be, the lender may see the need to procure an FSA guarantee, a loan guarantee. That's something that the borrower is going to find out about eventually, but because they have to sign papers all about that. But while that process is going on, the borrower generally doesn't know about that or may not know about that. And of course, any requests for additional conditions should be seen as another opportunity to tell a positive story, and having responses to know that you've already told the beginning farmer, because they're going to get the phone call, not you as the advisor. When that beginning farmer gets the phone call and the loan officer says, well, I've got bad news for you. We have to deny your loan. The first question from the beginning farmer is, well, what could I do to get you to say yes? What would I have to do to make this so that you would really want to make this loan? What do I have to change in my loan application, in my business plan? What is it that you need from me to get this to a yes? Again, it's another opportunity to tell a positive story about that beginning farmer's business. And then implementing the plan, actually getting the money from the lender, having a line of credit or getting a check deposited into the beginning farmer's checking account. It's a great day. I've got a whole pile full of money. Does that beginning farmer have a plan to spend that money? If they're going to build a high tunnel and buy a rototiller and put in some drip irrigation, what's the order of business? What's going to happen first? What do they need to do in a particular order? Helping a beginning farmer have a plan for how they're going to accomplish their business plan, what order it's going to happen in, where they need to expend their labor. Having them think through that is extremely valuable direction that you can give to a beginning farmer. And to some degree, you're probably going to get phone calls as an advisor to beginning farmers while they're implementing. They're going to want to tell you the successes, the failures, and your job is certainly not to run their business, but asking them good questions about their time management and how they expect to pull off this growing of crops and selling at markets or whatever the particular agricultural enterprise is. Helping them through that is, I hope, one of the enjoyable parts of what you do as an advisor to beginning farmers. Having you on a tour, even with the lender. Certainly having the lender come out and see what's going on is a good move. You never know as a farmer, whether you're beginning or not, when you're going to need to call your lender and say, things aren't going the way I expected. I'm going to be late on my payment. I'm going to have to borrow more money, whatever that is. Having the lender familiar with the operation and the progress of the operation is a way to instill confidence and to keep that relationship current, and I guess the easiest way to say it is available. Part of that is also having up-to-date financial records, being able to demonstrate as a beginning farmer that not only do you know financial records are important to be able to put on a tax form in March or April of every year, but those records are important for the purpose of managing the business and being able to say in financial terms to the lender when they pop in or even on a scheduled visit, here's my performance for the previous month, and be able to show that you have record keeping and you are measuring your performance against specific goals is probably one of the most confidence building things that a beginning farmer can tell to a lender. Finally, can't emphasize this enough for you as advisors, or if you're a beginning farmer listening in, to monitor your credit score, to encourage those beginning farmers to know what their credit history says. This annualcreditreport.com is the free version. It gives you a credit history. It doesn't give you a credit score. The credit score is arguably less important for a beginning farmer that needs to know if they have an impaired credit history of any kind. The last place you want to find out that you have a really low credit score is when you're sitting across the desk from somebody you're trying to borrow money from. Even if it's a case of mistaken identity, or even if it's a case of, gosh, I didn't know that I owed that person money, and now it's a blemish on my credit history. Knowing in advance allows that beginning farmer to explain in advance, to be able to disclose to the lender, when you look up my credit history, you're going to see that I didn't pay that bill to the anesthesiologist at the hospital because I never knew that I got that bill. I just never heard from them before, so I didn't pay it, and now it's a blemish on my credit history. I've since paid the bill. Being able to say what the impairment is, and then here's how I have rectified or solved that impairment, that problem on my credit history, is what gives a lender a great deal of confidence. This is one of those things that when you're talking about building financial skills for beginning farmers, you know, if you have a laptop or encourage them to do this at home, they may not want to do this in public, but encouraging your beginning farmers to do this, to look up their credit report at the beginning of your training, so that if your training is you know, months long or years long, there's a chance to find out that there's blemishes on the credit report, and that beginning farmer can, with your guidance, hopefully do something to solve those credit report problems. Steve, that's the end of my presentation. I'll hand the control back to you, and thanks very much for the opportunity for the Farm Credit Council to speak to some of the people in the Southern Sustainable Ag Working Network.
Great, thank you, Gary. We've got just a couple minutes for questions. If you have a question that you want to put in the question box, feel free to do that now. And while we're waiting for those, I'll just ask what we have already. How much, Gary, and these are questions for Gary, obviously, how much equity does a beginning farmer kind of need to expect he would need to have to perhaps get a loan? I mean, I'm sure it varies some, but any ballpark ideas on?
Steve, it would vary certainly depending on the type of farm operation. For your Southern SOG sort of borrowers who would be in a small-scale vegetable operation, who are beginning farmers, I would think that 30% equity is probably a minimum. Some beginning farmer programs that farm credit institutions have may, on occasion, allow for a lower level of equity. The thing to understand about borrowing money, this isn't getting a home with zero down kind of a situation. This is a commercial business loan. Businesses are risky. Farming is even riskier. So the idea of equity, of saying if you want to borrow $100,000, you need to have $30,000 because the lender wants to see you put some money on the table and say you're willing to risk money, in addition to asking the lender to risk money, is a reasonable equation. And that's basically the idea of equity, is what's the borrower willing to put up, what are they willing to put at risk, so that they can encourage somebody else to say, yeah, I'll risk some money along with that.
Okay. One last question, and then we're going to have to sign off here because our time's about up. It just seems like there'd be a lot more pressure on alternative farmers these days to really show profitability for their enterprises compared to conventional operations that have, you know, I mean, like a chicken house operation or something like that. There have been so many of them and that kind of thing. Do you feel like there is more pressure and that you really have to deliver if you're coming in with something different, like a CSA operation, or is that changing some now that there are more CSAs? People know what that is and that kind of thing.
Well, I think that the idea that a lender would be more familiar with CSAs, Farm Credit's work to establish some financial benchmarks for CSAs so that lenders and potential borrowers know what to expect of the business. One of the nice things about CSAs and the whole direct-to-retail environment is that it's generally a higher margin business. It works at a higher expected profitability because essentially it's a niche market. It's the opposite of a commodity market. So where the long-term net profit margin for a commodity corn and soybean might be 3 or 4%, the long-term average net profit margin for a CSA might be between 10 and 15%. So higher profitability is not unusual for a direct-to-retail, small-scale vegetable sort of operation. It's just up to the beginning farmer to be able to demonstrate they understand how exactly they're going to accomplish that and be able to describe it in a plan.
Great. Okay, well, our time is actually about up now. If you didn't get your question answered, or if you have another question, you can email us at the address on your screen there, and we'll make sure that you get the question answered. And I do want to thank you for joining us for today's webinar. After the webinar, you'll be given the opportunity to take a short 4-question survey that should only take about a minute, and we'd appreciate it if you complete that for us. And we also hope you'll be able to join us in Lexington, Kentucky, for SOG's 26th anniversary coming up in January. Thank you very much, and we hope you all have a great day.